don't want to hear Vietnam has a funding problem. Vietnam was about to be so in mining. It's just the wrong money. It was the next China. It was the next India. It was the next Indonesia. Then whatever the next thing was. Every one of those labels pulled in capital. Not one of them pulled in the kind of capital that funds a startup, funds a company, sticks around. If we go back to 2022 at the Vietnam Venture Summit, there were 41 funds that stood up and pledged $1.5 billion for Vietnamese startups. That pledge covered the 3 years from 2023 to 2025. Now, if we look at what's happened so far at the beginning of 2026, Vietnamese founders raised $28.8 million across 10 rounds. Yes, 28.8 billion. And next month, in September 2026, Vietnam is going to get reclassified by the FTSE Russell from a frontier market to a secondary emerging market. FTSE's own estimate is that about $6 billion of passive index follows it in. $6 billion arriving on a scheduled date into the stock exchange. Compare that to 28.8 million in the companies that are just starting out. Look, I don't want to hear Vietnam has a funding problem. Vietnam was about to be so in mining. It's just the wrong money. And I'll defend this next line that I'm about to say anytime to where I believe that Vietnam has the best engineering talent base in Southeast Asia. It also spent the last decade essentially being told that it was the next, well, maybe not the last decade, but at least the last recent years, that it was the next China, it was the next India, it was the next Indonesia, then whatever the next thing was. Every one of those labels pulled in capital. Not one of them pulled in the kind of capital that funds a startup, funds a company, sticks around, and helps out and hangs out looking for whether it worked out over the course of 7, 8, 10 years. So, to be honest with you, this episode is not about how much money there is. It's about what kind, because the amount was never the problem. I'm Kevin Brockman. This is the Startup. Real, raw, relatable. Let's get into it. So, you started a company to build a product, not to run a back office. But here you are. You pay an accounting firm every month, and once a year, you get a clean set of accounts. That is compliance. It's not clarity. It will not tell you if you run out of cash in March. It will not tell you what one new hire does to your runway. And it will not answer the question every investor asks: where's this business heading? So I built your CFO, your back office in a box. Your books keeps your accounting books current, and your CFO puts your forecast forward. In one login, your actuals flowing straight into your Outlook. Link your strategic initiatives, like a hire or a price change, to exactly what it does to your runway before you commit. Investor ready, operationally ready, in the currency that you work in. It is the back office I run across my own companies. Get your finances settled for your business today at yourcfo.tech. That's yourcfo.tech. There are four types of money flows that I want to talk about here in Vietnam. Three of them are running hard, and one of them has essentially been turned off. And almost every story that you will read about Vietnam confuses these stories, I think. Tap one, venture capital. That one is basically all. Through the beginning of this year, first half of this year, Vietnamese startups only raised 28.8 million. I think that's actually through a May figure, so not quite at 6 months, but still rough indication. And that was just across 10 funding rounds. In the same period last year, if you look at it, it was 227 million across 15 rounds. Not drastically higher in regards to deal count, still too small, but it was larger size deals that were getting done. And that is a fall in deal value of about 87%. That's traction numbers, caveating that I'm not the one coming up with this, but let me be fair about the baseline, because this is where people had a tendency of overcooking the story. Vietnam was never a billion-dollar venture market. Full year 2024 was $494 million across 68 deals. So this is not necessarily collapse from a summer high. It's a collapse, but it is something more boring and more serious. Because if you look at 68 deals becoming, say, 10 deals in a first half, that's roughly one venture deal every few weeks in a country of 100 million people with the big engineering talent pool in the region. And Vietnam is not alone. Across Southeast Asia, the first half of this year has been really bad. And the regional dollar totals, I mean, they held up because people have started stuffing the numbers with data centers and deals that should have never been included in startup funding reports in the first place. But if you strip those out, everything is down across the board. So it's not just a Vietnam problem, it's a regional problem, but it's definitely the sharpest version of a regional problem. Now you take tab two, which is the internet month. And this is running hard. If you look at this past April 2026, the FTSE Russell did confirm that Vietnam was going to be upgraded to secondary emerging market status effective September 26. That means that it's going to be phased into a global index series through the following year. And by FTSE's own estimates, that means that about $6 billion of inflows from passive trackers is going to come with it, buying those shares, which should end up seeing law of supply and demand appreciation of those shares. And the World Bank puts those near-term flows at about 5 billion, and it also says that long-term potential could reach 25 billion by 2030. Those are their numbers, not mine. Both institutions obviously have an interest in the story being good, so they hold them loosely. But even if those numbers are half that amount, it's still going to end up being the biggest single capital event in their modern financial history. Now, but here's the part that nobody really says out loud about this, which is you got to ask what passive money actually does. It buys the index by a pre-designed weighting. It does not read it. It does not take a meeting. It does not care who the founder or what the product is. It buys the listed companies in the country in proportion to their size or whatever the rating of that index is. I'm not 100% sure what the FTSE's methodology is because there's a few different methodologies. But essentially, it's buying on mechanism based upon the proportion to the index, which means in Vietnam, it's basically going to be buying banks, property, and retail. And when the money leaves, it leaves in the same way by weight. So if there's a rebalance date where it needs to reconfigure, it's going to flow out in the same proportional sort of rebalancing. So not $1 of that 6 billion is actually available to a founder with a working product and 18 months of runway or whatever. Not one. It's not that kind of money. Now, step three is borrowed retail money. Now, this is running very hard. Margin lending at Vietnamese brokerages hit a 445 trillion dong at the end of the second quarter, which that translates to basically $16.9 billion. 3 years ago, at the start of 2023, it was just 125 trillion. So that's basically 3.5 times more leverage now than just 3 years ago. And this is the bit that should make you sit up. That borrowed money is now the main thing absorbing foreign selling. So when overseas funds now Vietnamese stocks, it's the domestic retail investors on credit taking the other side. Now, I will give you the counter argument to this because it is a real one. The prevailing view among Vietnamese analysts is that this is not yet a problem. Brokerages have strengthened their capital buffers considerably. Margin calls in July were localized. Forced selling did not spread, and the system absorbed it. That is the majority position, and it's held by people who know the market way better than I do. I am not an expert on the Vietnamese market, but my read is a bit simpler. When the buyer holding your market up is borrowing to do it, your market is not is propped up. Contained and safe are different words, and the gap between them is where people lose money. If we look over to Korea, which just happened, also a high amount of retail leverage, all of a sudden there was a run on that leverage as the stocks came down, and that triggered a massive sort of margin call, which ended up driving and driving. And so it can become a problem quicker than people can realize. Top four, public listings. This is reopening hard. Four Vietnamese IPOs raised more than $830 million in the first half of this year, a combined market value just shy of $7 billion. And I'm going to hold that one because, top four is one that tells you the most. It deserves its own segment. So I'm not going to delve so deep into that. So let's put those four tabs side by side. Vietnam has built a functioning machine for turning domestic savings into listed equity. It has built almost nothing for turning savings into new companies. Both of those things get called capital market. Only one of them really compounds in industries that did not exist before. And think about what that does to, that talented 27-year-old in Hanoi who wants to build something. The shortest path to capital is not a seed round because there are 10 of those a year. It's a salary job at a multinational, a role inside a listed company, or a family business with a balance sheet. Every one of those choices is rational. Individually, they're all the right call. Collectively, they're how you end up with a country that has world-class engineers, but no company that anyone outside the country can name. Which brings me to the part to really talk about the talent. And so the thing about the story that actually irritates me a little bit. Vietnam has more than 18,400 specialized AI engineers. That is the largest pool in Southeast Asia. Demand for those engineers is running at 2.5 times where it was in 2023. And on technical and system design assessments, there's reports that the top tier Vietnamese engineers are scoring within about 8% of their American peers at a 60 to 80% lower cost. Now, disclosure on those figures, because it does matter. Most of these figures that I just quoted here are from recruitment forums, officer advisory, and other folks that are in the business of trying to sell you Vietnamese engineering. So take it directionally, real, but the decimal places of the fact figures maybe those end up being a little bit here and there. But even discounted heavily, the picture still holds. And it is a deep, cheap, genuinely excellent engineering base. And the world knows it. It is an exporter of talent. And look at what the world is doing with it. You see, NVIDIA has been expanding its hiring in Vietnam across manufacturing and operation roles, tied to high-end GPUs, with Foxconn reported as a possible partner. And it keeps AI and model development roles in Hanoi and Ho Chi Minh City. Now, I do want to be careful here because this is exactly the kind of story that can get inflated when in a group chat on a Friday. NVIDIA has not announced a factory in Vietnam. What is reported is hiring in roles that would be consistent with more advanced work. That is a signal. It is not yet an announcement, but take that signal seriously because it tells you the whole story in one move. The world found Vietnam's engineers and it decided to hire them and rent them. Now, nobody in this story is the villain. I want to say that clearly. NVIDIA hiring hundreds of engineers in Hanoi is good for Hanoi. It is good for those engineers. They get paid in hard currency. They work at the frontier. They carry none of the risk of starting their own businesses. And a 9-year-old engineer with a mortgage and a kid who takes a job over a startup salary is not making a weak choice. They are making the correct choice in many instances, given the options in front of them. The failure is that nobody local ever put a competing offer on the table, really. And I want to be even hand about whose fault that is because it's not only the money's. Investors in this region got risk averse and clustered around whatever was already working, which is how you get 10 rounds in the first half of this year. But founders own a piece of this too. Plenty of Vietnamese founders spent the last few years priced for a market that stopped existing in 2022, holding out for a valuation that was available once and is not available now. And the round that closes is worth more than a valuation you are still defending. That is not investor propaganda. That is arithmetic about runway. And the reporting around Vietnam's funding reset names constraints that are, unglamorous and real. You talk about reluctance to hire foreign expertise, the language barriers, the very real legal barriers that exist inside of the country. You have the foreign exchange rules that make Vietnam difficult, more difficult than funding a Singapore entity, which most Vietnamese startups do have a holdco structure in Singapore. So some of that is tradition, business culture, legacy. It takes time. It could take a generation. I mean, some of it paperwork could be fixed inside of a year if they decide to move on it. And in fairness, the government has done a lot of positive moves in regard to and progressively changing the rules of the game inside of the country to promote the ecosystem, to make it Mr. friendly, to make it more innovation friendly. But underneath all of it sits really one sentence, and it's the sentence I would put on the wall of every ministry in the region, and I'm put in the wall of every university. A salary is not ownership. When an engineer in Hanoi builds something X on an offshore contract, the value of what they built appears on somebody else's cap table in somebody else's currency in a company listed on somebody else's exchange. They get a good wage, which is not enough, especially if you remember what a good wage in Vietnam 15 years ago. But they don't necessarily get the primary asset. And I want to be fair to the other path because there is a serious counter argument, and it is called India. India's service industry created enormous wealth, built a professional middle class, and produced the management layer that now runs a big share of global tech. Nobody should sneer at that, but if you look at the shape of this story, that wealth accrues slowly and mostly to just a handful of very large firms. The product companies came a generation later. They came out of the domestic market to fund them. Oftentimes, the same people that left built offshore entities and then it came back, spun those into to new funding, angel network, etc. Now, Vietnam is being offered the same deal, say 30 or so years later, with a smaller domestic market and with AI compressing the window which cheap, excellent engineering is a durable advantage. Now, I invest at seed stage across this region. I will tell you what I actually see in the pipeline. Vietnamese technical teams are frequently the strongest engineering that we look at. What is missing is not ability. It is that fewer of them are choosing to own their own outcome because the local machinery for owning an outcome barely exists. It's still very nascent. Now, at this point, somebody is going to tell me that money is simply gone. Hard market everywhere. Rates are what they are. Nobody is writing checks. And that it's not that that's not necessarily false, but it's not fully true. And you don't need to leave Vietnam to prove it. Go back to tab 4 that I talked about, the one I held. 4 Vietnamese IPOs in the first half of this year, more than $830 billion raised. Combined market value just under $7 billion. And the one to look at is an upcoming one, which I'll brutalize this name, so please excuse me on it. But Vietnamese, it's offering to raise about $545 million. 93% of the shares on offer were already taken up, around 60 domestic and foreign investment funds turned up to the book. It has been cleared to list and starts trading soon. I think maybe it's already traded by the time this episode comes out. So what is this company? It's a chain of electronic shops. It's the retail arm of Mobile World Group, which itself already is listed in Ho Chi Minh. 60 investment funds for a chain of electronic shops carved out of a company that was already public. 10 venture rounds for the whole country in the first half of the year. Hold those two in thought. Same cities, substantially overlapping pools of money. Now, there is a cheap version of this segment, and hopefully I'm not recording it. This is a real business with stores, revenue, and staff. It deserves to be able to raise capital. And a working IPO market in Vietnam is good news. Good news for venture too, because a functioning exchange is the exit that makes venture possible as well. But if you look at the shape of what got funded, it's an established business attached to a listed parent with audited revenue and a decade of trading history at the very safest end of the risk curve. That is where Vietnamese capital showed up in size, and it showed up in numbers that would fund the country's entire startup base for the next 15 years. And it even showed up on margin because it was at the safer end of the risk curve for them. So let me put this whole episode into a paragraph, if I may. Vietnamese savers will put $16.9 billion of borrowed money into buying existing shares. Vietnamese foreign funds will put 545 million into one carve out of a listed retailer. Passive index funds will pour in 6 billion into the exchange next month because a committee in London changed the classification. The total that went into new Vietnamese startups was just $28.8 million. Nobody in that chain is doing anything wrong. Every one of those decisions is defensible on its own. And collectively, they add up to a country that will fund almost anything except a founder. There is one more number that explains uh, the gap. And it is the one I come back to regularly of the venture deals that can get done in Vietnam. Singapore-based investors account for about 39%. Domestic Vietnamese investors account for just 20%. Now, caveat is that a lot of times that you see Singapore domiciled numbers, the question is always a matter of, is that just the legal jurisdiction of where it is domiciled? Because for the vast majority of VC funds, they're going to domicile them in Singapore. There's only a handful of jurisdictions that are globally recognized and acceptable, except for perhaps government, corporate, or arms of the VC, areas of the VC that are more localized in nature. But if you're raising a traditional VC fund, there's generally only a handful jurisdiction. So it may be that Singapore number is inflated, but what we can take from it is that because the number is small to begin with, we should expect that a lot of it is going to end up coming from the smaller emerging manager segment, the seed and pre-seed funds, as well as angel networks. And given that percentage, it seems like there's not enough domestic participation. So the risk capital that does reach Vietnam is mostly foreign and mostly arrives through Singapore, while domestic capital, which honestly is vast stays parked at the same time, which means the Vietnamese founders get judged against your foreign comparables, your Singapore timelines, Singapore governance formats, and people are flying in. And the most common piece of advice those founders receive is to reincorporate in Singapore, which quietly moves some of the value of anything they build of the country before it exists. Now, mind you, as long as the operations are still there, the legal domicile on the top is more of a tax strategy than anything. But nobody in that arrangement is paid to be first. And being first is the entire job of C. So if you are building in Vietnam right now, and you have been listening to me describe your funding market set of taps that are pointed somewhere else, here's what I would actually do with this. Four things, and honestly, none of them really come from me. So, number one, assume there is no local lead investor coming. Not as pessimism, just as sheer planning. 10 rounds in 5 months means the odds of a domestic lead hitting you when it's long are close to zero. So build to the point where a foreign check is a decision somebody makes on numbers rather than a favor somebody does you after an introduction. Two, price to close, not the signal. A $500,000 round that closes in March beats a $10 million valuation. We're still trying to explain come November. Your valuation is not your runway is. And three, if you take state money, read carefully what milestone it is actually measuring. I don't know the Vietnamese ecosystem, but I do know many other government ecosystems. And if it measures customers, revenue, or retention, take it and be glad. If it measures headcount, local presence, or filings submitted, understand that you've just been handed a set of targets that have nothing to do with whether anyone wants your product. That is not a reason to refuse it per se, because money is money and you need it in order to survive. But it is a reason to keep two sets of numbers: the one the grants and the one that tells you the actual truth about your business. Now, number four, on the reincorporate in Singapore device, which you will get from every doctor you meet, it is often the right call. And I'm not going to pretend otherwise. The right call in almost basically every country in Southeast Asia, with the exception of Singapore, because you're already in Singapore. Just be clear-eyed about what it does. The company becomes fundable, and the value it creates, it starts disconnecting the brand from Vietnam. But as long as the founders are still there, it's probably the best decision. But do it because it solves a real problem for you, not just because somebody told you what a serious founder does. And to be fair to money for a second, none of this is unique to Vietnam. I would say it of KL, Manila, Bangkok, anywhere. So, what fills the hole? The same thing that always fills it. The government has kind of stepped in for it. Ho Chi Minh is setting up a municipal venture fund. Structure is roughly 60% private, 40% state. And, credit where credit is due. The state money only pays in after private contributions are complete. There are target allocations across semicon, AI, digital biotech, medtech, green tech, robotic. The eligible company does have to be legally established in Vietnam and commit to operating in Ho Chi Minh for at least 5 years. And alongside it, Vietnam has also set up international financial inaugurated in Da Nang back, I think it was in January and in this past February. Now, last week, last episode, I made almost exactly this argument about Malaysia. Different country, same quarter, same conclusion. And I'm not going to apologize for the repetition because repetition is partially the story. Across Southeast Asia right now, private venture is thin enough that state has become a marginal buyer of startup equity. When that happens, the state sets the price. And whoever sets the price sets the behavior. The design here is better than most. State money following private money instead of leading it is a correct way around, and somebody in that department understood the problem. There's still questions in regards to who's running it, background expertise, because we've seen the story play in Malay, even not more fair. Two places I would push back. First, 5-year local presence requirement. I get it because it's state funds, but it could potentially put a constraint on a company that does need to move where its customers are. Um, Second, you know, this is a trap I flagged in the Malaysian numbers. Allocations are targets, not deployed capital. The budget line is not money into a founder's account. So uh, take that. And there is a quieter risk that nobody puts in a press release. When the state is the buyer of last resort for equity, companies have a tendency of reorganizing themselves around the milestones that they want, as opposed to real customers and real durability. You can hear it in pitch when it happens. The deck starts answering a scoring rubric. The roadmap starts matching sector allocation. And a company that was built to satisfy a rubric is very hard to turn back into a company built to satisfy a market. Vietnam was the next China, then was the next India, then it was the next Indonesia. And it shouldn't be the next Vietnam. Every label that went along with it brought in money that wanted the story. Hot money came in, hot money went out, and every time the story got difficult, it just kept on flooding out. The talent survived all of it, which tells you the talent was never really the problem. So here is the test, and I think it is a fair $6 billion of index money arrives in September 2026. State back fund is being assembled for Ho Chi Minh. Ask again next year in August whether any of it produced one company that somebody outside Vietnam can make. If the answer is no, then we can stop calling this a funding gap. The money was here. Maybe it was just never designed for the founders. That is the episode. I'm Kevin Brocklet. This is CX Startups. Real, raw, relatable. We'll see you next week. And that does it for this episode of Sea of Startups. If you've enjoyed what you've been listening to, please give it a like, give it a review, subscribe to our channel. A little bit of feedback goes a long way in allowing us to keep on putting out these kind of episodes.